Good afternoon and welcome to BizTech's Asian Midday Market Watch. I'm Brian Fernandez, and with me is my co-host Jeffrey Halley. Our guest today on the 10th of January is Kelvin Wong, Senior Market Analyst at Oanda. Kelvin, good afternoon.
Hey, good afternoon to you, Brian and Jeff.
Now, Kelvin, before we get your insights, we're going to get Jeff to give us an overview of the numbers across the region. Over to you, Jeff. Jeff, can you hear us?
Looks like I'm having some connection issues over here, Brian. So maybe you want to read the markets out.
Not a problem. So the KLCI is down 0.67%. Shanghai is down 0.19%. The ASX All Ordinaries is down 0.59%. The Nikkei bucks the trend. It's up a whopping 2.08%. The Hang Seng is down 0.62%. And rounding up the numbers, we've got the Kospi, which is down 0.71%. Kelvin, your views on market performance in the first half of the day, particularly the standout Nikkei 225 number?
Yeah, sure. So let me touch on the Nikkei 225. So currently the Nikkei 225 right now is more of a bullish momentum play. So why do I say bullish momentum? Because this morning it did a stunning bullish breakout from a 7-month range that is in place since June last year. So it's a clear bullish breakout from this 7-month medium-term range of 33,800 level. And right now it's actually touching a 34-year high. So what we could see in the current momentum of this Nikkei 225 is more likely driven by internal factors rather than the movement of the dollar yen. Because for those traders who are actually tracking Nikkei 225 or trading directly Nikkei 225 in the past, they tend to have used this direct correlation of this dollar yen versus the Nikkei 225. So if you look at this long-term direct correlation on the dollar yen and Nikkei 225 has more or less been tempered off in the last 1 year or so. So what we could see right now over here is a potential, we call it resurgence, or what I call consumer confidence, a potential increase in domestic spending, and as well as a return of what I call foreign funds inflow into Japan that's actually driving this ongoing potential bullish movement of this Nikkei 225. That is, if you look at the current price action right now, Nikkei 225 is actually outperforming the current year-to-date performance of the US benchmark stock indices as well.
Now, Kelvin, one of the key things this morning was the RBA inflation numbers, which just came out about an hour plus ago, and they came in lower than expected. So for our audience, the Australian weighted consumer price index came in at 4.3% year on year for December, slightly lower than the 4.4% increase expected from a Reuters poll. Tell us then, Kelvin, what's your view on this? And is this, as some analysts are saying, the end, perhaps the end of rate hikes in Australia?
Yes, precisely. So if you look at this current situation right now in the Australian economy, the CPI number is more or less broadly in line with this global deceleration of heightened inflationary growth that was seen the last 1.5 years. So yes, indeed, it came down to 4.3% for the month of November. So that's actually the lowest level since January 2022. But bear in mind over here is that 4.3% is still a bit of room more to go down to RBA's target of 2 to 3%. So that's close to about another 2 percentage point more to go. So if you look at the gap itself over here, is still rather wide versus other major economy like the US and the Eurozone, which has a much, we call it a narrow gap versus their current CPI growth and versus the current CPI growth and their targeted so-called central bank targeted inflation rate of 2%. So all in all, right, I do expect that yes, we may start to see the end of rate hikes for in Australia, but however, the RBA will be less hesitant to actually start to kickstart interest rate cut this year versus the much more dovish expectation that's being portrayed on the US Federal Reserve, where markets actually expecting the Fed to cut as soon as March this year, with the current odds pricing right now based on the CME Fed Watch 2 is close to about 60%. And all in all, market is still expecting a 6 rate cut to come in before 2024 ends in the US. In the US, pardon me.
Now, again, markets are expecting 6 rate cuts, and that's why markets are hot, right? Is this
Yes,
really
precisely.
sustainable?
Okay, so to look at it at this point in time, yes, for sure, right now the market is actually banking on more of a two scenario is liquidity easing scenario, really, that is putting on this risk on behavior and also a bit of FOMO behavior as well for traders who actually missed the rally at the start of this year, at the start of next year, at the start of last year, pardon me,
Last year.
which, yeah, pardon me, last year, especially in the benchmark US stock market. And also on the other hand over here is that people traders are also looking at, yes, potentially there could be a slowdown in global economic growth, which US leading the fort. But bearing in mind over here is that we need not, yes, it's a slowdown of economic growth, but not leading to a kind of a recession-like scenario. Because if the US were to slip into a recession, especially a severe recession, that could actually see earnings growth starts to temper off as well in 2024. Because if you look at earnings expectation poll by Reuters and FedSet, they are looking for a what I call double-digit earnings recovery in US in 2024. And also one thing, a wild card to look out for over here is oil price. Do not forget why oil price is important, because oil price is actually one of the driver that drives up inflation expectation. So inflation expectation and oil price move hand in hand in terms of a very strong direct correlation. So yes, we seem to see oil price from the close to about around summer $90 high per barrel, now dipping to around 70 per barrel. So as long as oil price didn't surge back up to $90 per barrel again this year, we could still very much keeping alive the Fed dovish pivot alive, which in turn still support this ongoing bullish bull run in risk asset. That means we're talking about benchmark stock indices, accepting China, which we have a deflationary problem right now, at least in the first half of this year. So towards the second half of this year, I'll be much more cautious. Why? Because we will start to see a potential uptick in geopolitical risk again, notwithstanding that we do have a US presidential election coming towards the end of this year in November 2024. So towards the second half of this year, we will start to see much more play out of the candidates debate around US national security. So that will actually boils down the fact of China as well, given the fact that China has made its top priority for this year is what I call a modernization, or say continued modernization of its high-tech industrialization push, which center on we call it high-tech semiconductor know-how, and bringing closer to this. I would say that getting much more of this supply chain closer to China's bill. So that could actually lead to what I call protectionist list, and as well as a policy that is being played out by this US presidential candidate, which could potentially increase geopolitical tension risk premium when we come to the second half of this year.
Now, finally, Kelvin, US CPI numbers are out tomorrow.
Yes.
What is your expectation?
Yes, for sure. If you look at the numbers right now, I'm paying a very close attention to two components of it. One is the core inflation rate. So the core inflation rate, we strip out the ex-food and ex-energy. So core inflation rate, market is expecting to come down slightly lower, 3.8% year-on-year for December, below 4% year-on-year that was printed in November. So that's actually close to a 2-year low. So if core inflation continues to remain subdued over at this point in time, the Fed could be much more, we call it inclined to actually kickstart their first interest rate cut coming into at least in the first half of this year. So that could actually put a bit of downside pressure on the US dollar again. But bear in mind over here is that there's one interesting component, or say important component within the CPI number is inflation. We call it inflation services, or we call it services prices. So services prices, surprisingly, in the month of November, managed to tick up slightly to around to be precise, 1.17% year on year, a slight uptick from 1.05% year on year in October. So if in the month of December, if that means, i.e., that means this coming Thursday, if December print on the services inflation component continue to remain resilient around 5.15% to 5.2%, that could be a bit of a sticky scenario where the US Federal Reserve may start playing down on market expecting on their dovish side of the story, that is portraying pricing in 6 interest rate cut to come in 2024, and as well as the 60% odds of the first cut to come in March. So Federal Reserve officials may start to downplay this dovish current put it optimism or dovishness that's being portrayed by market participants if the services inflation component starts to tick up above 5.17% in the month of December.
And finally, Kelvin, cryptos have been gaining a lot of the attention lately with markets for quite obvious reasons. But gold has quietly gone about its business and rallied quite steadily over the last 3 months, and it seems to be comfortably above $2,000 an ounce at the moment. Could you perhaps give us an updated technical outlook as you see it for gold right now?
So for sure, gold has been trading above this upward sloping 50-day moving average, which is indicating to us that its medium-term uptrend remains intact. So, but however, in the short term, given that we do have some risk event that is taking shape this week, especially with US CPI data, so do expect to go to trade within a short-term range between 2,000 to 2,060 as we head into the CPI data release on this Thursday. That spot gold, which is XAU/USD. So in the short term, for sure, in order for gold to gain more pronounced short-term bullish momentum, you got to have a clear hourly close above that 2060 near-term resistance.
Now, Kelvin, on that note, thank you very much for your insights and thanks for coming on the show.
My pleasure.
Now, we've been speaking to Kelvin Wong, Senior Market Analyst at Oanda, and this has been BizTech's Asian Midday Market Watch. I'm Brian Fernandez.
And I'm Jeffrey Halley.
And this interview will be on our website, www.biztech.asia. Please like and subscribe to our various social media platforms. Thanks again for tuning in.